Well, good morning and thank everyone who has attended today. Another pretty interesting week in markets dominated yet again by the US dollar and US interest rates. There really is a story right now about those two things. Before we go and get into it, I'll go and get you to read the risk warning on your screen and just remind you that any information in this webinar is general in nature. Again, I like to try and make this as interactive as possible. So if you have any questions in related to the subjects that I'm talking about or a market that you're interested in, please shoot it through on the platform and then I'll endeavor to go and answer it at the end of the webinar. Well, good morning from a lovely, sunny, warm Adelaide day. Yeah, it's been a pretty interesting week to say the least. Of course, we saw the US election last week. And then this week, we've seen the byproduct of that particular outcome combining with very, very strong US economic data to go and produce an environment where the US dollar is just absolutely ripping higher. And it really comes down to the strength that we're seeing in bond yields rising across the curve in response to the greater growth and inflation outlook, and that is really fueling the US dollar strength. So I just wanted to go and have a look at some of the factors behind that. Not spend a lot of time this week because we have a pretty quiet calendar coming up, which means that potentially we could go and see a near-term reversal of some of those trends. But let's get straight into it, and I'm going to go bring up, first of all, a quick look at what's been going on. So I'm sure many of you who've woken up this morning may have seen Jerome Powell's comments speaking in Dallas. Certainly sounded a little bit more hawkish than what was the case after the Fed meeting last week. And of course, we've seen the CPI and the PPI reports that have come out since that particular event. And he was talking about the strength of the US economy meant that they can go and afford to be a little bit slower in getting rates back to neutral. He wants to go and reinforce that point. He was saying that no, the strength, and if you can go slower to try and find where neutral is, they will go and take the opportunity. So the market has responded accordingly. So just to go and explain what's going on here, these are Fed funds futures, and they're the shape of the curve to go and derive what is being priced in for particular meetings. Now, on the left-hand pane here, you can see this is the looking basically at the Fed's December FOMC meeting. And back around about the time of the Fed's first cut of the cycle, where that 50 was delivered, markets were flirting with the idea that potentially we could go and see another 50 basis point move at this meeting. 25 was fully priced. Well, now I can tell you it's deemed a coin flip. And it's pretty obvious at the moment, given the movement we've seen, particularly after Powell's speech, that markets are becoming very, very familiar and almost comfortable with the idea that the Fed could easily skip the December FOMC. When you look further out, you can see here, this is the shape of the curve between November of this year and December of next year. And you can see right now, 75 basis points worth of cuts. That's 325 pointers. You can see here at the time of the Fed's first cut of the cycle, back on the 17th, or just before the 17th, you can see here, markets were looking at the idea of 8 over that period of time. So we've seen a big shift in what's been going on when it comes to the front end of the US curve. And that has been very influential when we talk about bond yields, treasury yields that are for a longer duration. So you're talking about 2 years, 5 years, 10 years, and 30 years and the like. They've all been moving sharply higher. Just to go and reinforce that point, this is looking at the what's been going on with US yields, 2 years here on the left-hand side, 10 years in the middle pane, and 30-year yields in the other pane here on the right-hand side. And just to explain what we're looking at down the bottom here, the blue you can see is the rolling 24-hour change in each of those particular markets. One way or another, you can see here, we've got 2-year yields are now back at multi-month highs, and that's in response to what Jerome Powell was talking about a little bit earlier on this morning, our time here in Asia. You can see here, 10-year yields were at multi-month peaks up until yesterday, but the fact that we've seen markets move to go and reduce the amount of easing which is expected from the Fed moving forward, well, that's actually gone and tipped US 10-year yields slightly lower, but still you can see the trend is pretty obvious. So it was down about 2.8 basis points over the course of the past day, where it's sitting right now. And same again for 30-year yields. They too, when it hit multi-month highs on Thursday and have since reversed, in part due to what Jerome Powell was speaking about today. No, of course, you're talking about monetary policy that's not as accommodative as what was previously thought. That points to an outlook of slower economic growth, weaker inflation, so it kind of tips the curve a little bit, if that makes sense. And we're seeing that today. But you can just see more broadly, the trend in all durations right now is that we're seeing lots and lots of moves higher across yields in the US curve. And that's really important when it comes to a lot of different markets, because it's not quite the case that it's all one trade, because of course we can talk about other markets that have not been really impacted that much as yet by the change in the interest rate environment. But certainly from an FX perspective and a commodity perspective, it has been really influential right now. What you can see here on this screen, there's a few bits and bobs to it. I'm just going to go and just run through a couple of markets just to go and underline that particular point. So what we're looking at right now is we've got rolling correlations with various asset classes. And right now, this has got the New Zealand dollar. I was writing something up a little bit while ago. And what we've got is rate cut pricing here out until the end of 2025. We have 2-year yields, 5-year yields, 10-year yields, and 30-year yields. And so the correlation coefficient scores are based off the relationship that we've seen over the past fortnight. So that encompasses either side of the US election. And just like taking the Kiwi dollar for an example, I know it's not the most readily traded market, but you can see here, 5-year yields, negative 0.89 score. So that means that when US yields, 5-year yields have risen, almost always we've seen the Kiwi, New Zealand dollar, go and fall against the greenback. So it's been really, really powerful. And it's not the only currency that's been in that particular boat. Let me go and change it around and say, let's go have a look at the Aussie dollar. So you can see here, much the same again. Looking across, I know the timeframes here, in particular 2-year yields, negative 0.82, negative 0.86 for 5-year yields. So again, very strong inverse relationship. Yields go higher, Aussie US tends to go lower at the moment. You can really see that as well. Say in other, this is the daily chart here, just to go and demonstrate the point. You can see here, so we've got US 5-year yields ratcheting higher. As they've ratcheted higher, Aussie sunk. And the only time that really sort of interruption in that trend was around the US election, where we saw a bit of a snapback after the initial market reaction. But of course, that has not lasted very long at all. It's not just Aussie. You can go down. Here's dollar yen. Oops. It is a bit of a joyful day. There we go. Dollar yen. Just look at some of the scores here. So it's more about the belly of the curve, so between 2 and 10 years. That's been really, really influential on dollar yen movements. You can see here 10-year yields, 0.96 correlation. So that's almost in lockstep with one another. So directionally, they almost always are moving in the same direction over the past fortnight. Same again for 10 years, 0.95, almost as strong. So really, really influential at the moment. And so you can go a whole list, like even like some euro, which isn't always typically driven by interest rate differentials. Right now, it is. You can see here, scores across the curve here, 2-year yields, 5-year yields, sitting at minus negative 0.94, minus negative 0.91. So again, just reinforcing the point. Things like gold. Gold has been so resilient for a long, long period of time. And then all of a sudden, that has obviously not taken place. Let me go and get to the right contract here. So you can see here the correlation between all those particular interest rate markets and gold. For 2-year yields, negative 0.95. 5-year yields, negative 0.96. So kind of the front end and the belly of the curve, which is really impacting directional movements in the gold price. Same again for silver. Go and have a quick look at that. I was just writing about it a couple of minutes ago. And again, negative 0.92 for 5 years over the past fortnight, negative 0.93 for 2-year yields. So it's really, really comes across as just being almost like just one trade at the moment. It's US rates, US yields, fueling upside in the US dollar against a basket of other currencies, and that's including the likes of the CNY, even with some evidence that we're seeing the PBOC push back against some of those market moves. So that's the thing to go and remember when you're trading next week and you're thinking about setups. It comes down to what are US yields doing, because US yields have been very influential on US dollar movements against a whole bunch of different currencies and in the commodity complex as well. Now, one thing I want to go and demonstrate as well is that I think that whilst those trends, dollar strength, high US yields, are unlikely to go and change anytime soon, one thing that really stands out that after the retail sales report in the United States that we go and get later on in today's session, we're going to have a dearth of economic data in the United States, or at least top tier economic data. So let me just go and change this around. I'm just going to clear everything and just put it to the US, because at the moment it really is the US economy and the US economic data which has been so influential on those expectations about what the Fed will do and what's driving yields and dollar higher. So let's have a quick look at the calendar coming up next week. It's going to be not a lot to speak of, to be honest. So we get lots of Fed speakers. But of course, we already know that Jerome Powell has come out and said that they're data dependent. They're contemplating slowing down the pace of rate cuts. That's already priced in. So we already have that expected. And then I don't think we're going to see too much of a change now that Powell has gone and put that out there from the other Fed members. So anticipate that that's already built in to market pricing right now. And then when you look at some of the other things that are coming up at the moment, Monday is just a write-off. There's nothing there. Building permits, housing starts, very, very cyclical in nature. They're expected to be weak. High interest rates, of course, weigh in activity there. But we know that it's not going to go and really create any big surprise, and it's very, very unlikely to go and create any movement in the US dollar or US yields. Again, on Wednesday, almost nothing. A 20-year bond auction. Look, bond auctions are important, but 20 years is a tenor that not a lot of market participants like. And so it doesn't really give you a really strong read as to what demand is like for longer dated debt in the United States. So again, that doesn't really loom as a potential big event. And then you get into things like jobless claims. Well, they fell to multi-month lows last night, so continued strength there. Hard to go and see those trends changing anytime soon. Then a whole bunch of soft surveys, Philly Fed Manufacturing Index, existing home sales, and the like. You can see here. And then we get the flash PMIs on Friday, which for Europe's case, markets seem to go and pay a lot of attention to. But more broadly, in the United States, no. Look, it's been probably a better read than the ISM, the PMIs that have come out from S&P Global recently, if I'm being honest. But the markets, it depends on what they want to be driven off. And the evidence suggests that they don't really care too much about this particular this reading. One thing to go and keep a close eye on, consumer sentiment. See how that reacts when it comes to the presidential result. We know it's going to be very, very split, a divide between the voting blocks between Democrats and Republicans. But then have a look here. Inflation expectations are going to be really important because the Fed is telling us that they believe inflation expectations are anchored right now. Well, market inflation-based expectations, I can tell you, are not. I'm just having a quick look here on the screen as to what markets expect the average annual inflation rate to be over the next decade, according to inflation break-evens, 2.35%. That's off its highs that we've seen recently. That's still 35 basis points above the Fed's mandate. So already you've seen the evidence that it's not running away from the Fed by any stretch of the imagination, and that's been helped by the other pivot when it comes to being less dovish in nature. But still, if we start seeing consumers expect that inflation is going to go and pick up, then hang on a second, that might go and encourage spending. It might go and embolden them, particularly at a time when the US labour market is still pretty strong, to go and demand greater wage increases. Then, of course, we're back at square one where we were a couple of years ago and the Fed having to go and tighten rates pretty aggressively. We don't want to get back to that point, so keep a close eye on that particular report. So in a nutshell, that's kind of what to go and expect next week. We have hawkish pricing from the Fed. The US dollar has got all of that priced into it already, and we have almost no major economic data or events out in the United States. So whilst that's not going to go and really shift that environment, what it could do is provide a window for some counter trend moves across a variety of these asset classes that are being absolutely pulverized by space, even some of the moves that we're seeing in commodity markets. Is just maybe some of the markets here, so we go and find where my mouse is. There it is.
slow here, so do excuse me here. Alright, let's have a look at the weekly chart. I want to have a look, just kicking off with the DXY. So, one thing that's really struck me about this is that we've seen this trend line. Now, some people might not like it, might be invalidating in some people's views because we've seen the price go and trade through it a number of times, but I just want to go and highlight what we're seeing since it was first created is that we're seeing lots of probes above it, one close above it, and then that didn't last long. Another flirted with the idea. You can see it's been trending lower, 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 lower. Then all of a sudden, we've just seen this massive bullish breakout. You can see here, bounced really strongly, and it's gone through and taken out the highs that we saw earlier this year. Now, that's not going to reverse majorly anytime soon, given what we've been talking about with the calendar next week. But to me, it's moved so fast, so quickly, and so much good news is priced in right now. So to me, when you look at some of the other markets out there right now, let's go and zoom in a little bit when it comes to time frames. Let's go and have a look here at, say, what's going on with the euro. Just totally ugly, and you can see here, just shearing off a cliff. It's not just the US economy side of the story when it comes to the euro, but just look at what's going on with Germany's government. There's not much of a plan. There's talk that the ECB might slash rates by 50 basis points at the next meeting because there's just so much turmoil going on when it comes to Europe's largest economy. And you can see here, it actually went and took down and took out the low that we saw back in November last year. It's now oversold though, and we have nothing really on the calendar coming up. Yes, the momentum indicators, RSI 14 and MACD, are looking pretty ugly right now, but we've got very, very oversold conditions. We have an environment where there's not a lot of news, and so it's just one of those kind of periods where it would not surprise in the slightest to go and see some kind of reversal, squeeze, short covering rally, and the like. I don't expect they'll last long if they do take place next week, but it's just something to keep in mind because a lot of bad news is already factored in to a lot of these names. Have a look at the yen as well. It's just in beast mode. You can see here it's been bouncing up against this uptrend, also finding support at the 200-day moving average. And last week, I went and looked at what was going on here. I could see RSI 14 was trending low while the price was trending high. That divergence got me worried about a potential shift lower. Also had MACD was giving a bearish signal. Well, that's just completely changed this week. You can see here it's gone and broken RSI 14. MACD has also gone and flipped over from below. So that's confirming the bullish signal, and it's just been breakout central. 155.36 is one level that I'm keeping a close eye on the downside. You can see it came back, kissed that level, and then it's just bounced off it again. But again, a lot of bad news is priced into the yen, a lot of good news is priced in to the US dollar. So at this point in time, I don't expect there to be a major reversal, but if we do, keep an eye out for 155.36. Otherwise, we're talking about 160.23 moving forward. Let's have a look at the Aussie really quickly as well. Much the same sort of story. You can see here, I had this downtrend intersection with minor horizontal support around about 65.13. It broke through that yesterday. I said that at the moment, there's a lot of good news priced into the labour force survey in Australia. It came out, the employment growth is a little bit weaker. You can see here, as soon as it's gone and broken this level, from a technical perspective, it just explains everything. You can see here, falling out and of course continuing to go and slide right now. RSI 14 broken this uptrend, MACD crossed over from above. Momentum is all with the bears, favour selling rallies in the near term. If we do go and see a squeeze, no, I'd expect that it'll be probably back up maximum towards this level. And if that was the case, and it wasn't accompanied by a big reversal in US yields, I favour fading that particular move as well. That's a pretty good goal as well. Getting a lot of attention, and I don't mind this daily candle here on Thursday. It's the same candle as well that pretty much we've seen on the silver price as well on the daily time frame. So you can see here, it's gone and broken multiple uptrends over the course of this week, including the 50-day moving average, which on occasion has been pretty influenced. So from that perspective, I'm not surprised you're going to see the gold price coming off in line with what we're seeing with fundamentals as well. However, you can see here, 2531.81. So this level here, cap gains for a long period of time back in August, and then all of a sudden we had the breakout, and it got close to that level, and then it's popped. So we've got a hammer candle here. So maybe, just maybe, we're already seeing the first glimpses of a potential squeeze taking place in gold. We're not there yet, but just that signal alone is one to keep an eye on. RSI 14 is something that I like to go and use as a confirmation for any price signal. It has not yet broken its downtrend, but you can see right now it's getting very, very close. MACD at this point is still giving a bearish signal on market momentum. Anything else that comes up at the moment, I'll remind you that if you have any questions, please shoot them through. We'll wrap up in the next couple of minutes or so. Let's just go finish off having a quick look at dollar Chinese yuan as well, because it's a market that is getting a lot of attention right now, because across the broader EM space, and then for the likes of the Aussie dollar and the Kiwi, the fortunes of what happens with the yuan are going to be very, very influential. And you can see here, it was banging up against the 200-day moving average for quite a period of time, and then it's broken above that level. And you can see here, around about 7.2, that now is likely to go and act as support, in my opinion. You can see here, big Dragonfly Doji that took place on Wednesday. And now we're banging up against this level here, around about 7.25, 700 or so. And you can see here, that was a level that acted as both support and resistance in the course of this year. Beyond that, 7.2973 is one topside level, and then this former uptrend as well, which is located at this point around about 7.29100 or so. There's evidence that the PBOC has been pushing back against relentless US dollar strength, and whether that can go and persist though, given the threat of trade wars and tariffs and the like, will be very, very interesting. But that to me, you can see here, the uptrend in RSI 14 has been broken, so this is the first warning sign that potentially we might be looking at a shifting momentum. And if that is the case, then it does go and point again to the potential that we could go and see some squeezes in other G10 FX and some EM currencies against the US dollar in the near term next week. With that, I think I might go and wrap up. Obviously, it's going to be a quiet week coming through next week. But I just want to say thank you to all those who attended, and I hope you have a fantastic weekend. Good luck with your training next week, and I'll catch you on Friday. See you then.